So, the roadmap for bringing England out of lockdown has triggered a new rally in stocks that were previously hit hard by restrictions imposed by the government on businesses and individuals. And it comes almost 1 year to the day since we saw the start of the global stock market crash, which ran from the 24th of February until reaching a bottom around the 23rd of March 2020. What may surprise some people is the scale of the recovery for many of the worst hit stocks. Some of the pub groups and retailers forced to close their doors for several periods during the pandemic now have their shares trading at nearly the same level as just before the coronavirus gripped the world. This is remarkable when you consider how their earnings have been significantly dented. Pubs Group Fuller Smith & Turner is only trading 5% below its level on the eve of the global stock market crash in 2020. And to put that into some context, the FTSE All-Share Index, which covers most of the UK stock market, is down 9% over the same period. So the reason why many shares of so-called lockdown losers have recovered is down to how the stock market works. The amount investors are prepared to pay for a stock is based on what they think will happen to a company and its earnings in the future. So, for example, someone buying shares in a pub company will be more concerned about the next 12 months' earnings and not about the last 12 months. Shares in high street retailer The Works are trading 11% higher than on the eve of the 2020 global market crash. This is despite its physical stores being closed for many months. So investors have been excited about the company's growth in online sales and how it may not need to be as reliant on physical stores in the future. And clothing retailer Next is up 7% as it's demonstrated to the market that its online sales growth has been very strong. Even some of the recruitment companies have seen their share prices bounce back, despite the UK's unemployment rate reaching 5.1% in the 3 months to December 2020, according to the Office for National Statistics. That represents the highest level for almost 5 years. So nearly 10 million people were on furlough in the UK as of mid-December 2020, according to HMRC data. You would have thought that backdrop would be terrible for companies trying to help people find work, but anyone buying shares in a recruitment company will be looking to the future. The roadmap to reopening the economy is music to the ears of recruiters. There's a joint study by the Chartered Institute of Personnel and Development and Adecco in February 2021 found that more than half of UK employers intend to recruit staff in the next 3 months. That might go some way to explaining why shares in the biggest UK quoted recruiter Page Group are up 8% since the eve of the global market crash. Now, while there's plenty of companies playing catch-up, there are still some names lagging the pack, including a few leisure specialists such as Hollywood Bowl, which is trading 20% below its pre-market crash share price level. Airlines and cruise companies are even worse off, with some trading between 30 and 50% lower than the eve of the market crash. To give you some examples, Jet2 is trading 29% lower, while International Consolidated Airlines is 56% lower. And it's worth noting these types of companies were among the biggest risers on the stock market after Prime Minister Boris Johnson revealed his reopening roadmap on the 22nd of February. Nonetheless, there's still many unknowns for this sector, such as whether vaccine passports will be required to get on a plane or when other countries will decide to let in tourists. That might explain why they're lagging the pack, but investors certainly seem to be looking at these stocks more seriously, judging by the way they perked up since the Prime Minister's roadmap announcement.